All right, welcome everyone to today's topic where we are looking at the federal budget impact on SMSFs. My name is Aaron Dunn from Smarter SMSF. And if you were like me, you kind of get a bit nervous on budget night, wondering whether you're going to be spending hours and hours and hours on end. And I do remember that in 2016, I think I was still doing interviews online that had a 3 in it at least, to other years where you literally do the Control F on super and superannuation and SMSF, and there's virtually nothing there. And this time it certainly fell into that category rather than what we have seen in the past. But there were a few little things that I want to touch on, and also want to give a bit of a precursor, because I think this is, in many instances, being an accountant myself, I kind of look at a budget in October and I go, it's not really a budget, is it? We are a quarter of the year along. It is really a bit of a reforecast, and you're not looking to see significant new initiatives into it. I think what we're going to find is we're going to find far more in our May budget next year. And I think from this, you'll see today, there are areas that may be actually ripe for change, but we'll go through those and discuss in a little bit more shortly. As is always the case, we do put our disclaimer up to ensure that you're aware of the content that we put today is based upon our own information, and ensure that you go away and look at it yourself. So in terms of what we're going to cover today, we're going to really break this into 2 key parts. We're going to be looking at what we're covering, what has been announced, and then what hasn't been announced. And as I said at the very beginning here, it was a super silent budget. So most of what we've seen really fell into some of the commitments that the Labor government made during the election, looking at things like multinationals, trying to address issues around inflationary impacts within the economy at this point in time. Now, that doesn't to say that superannuation hadn't been on the agenda and for discussion. And if you, like me, had been following what had been discussed in the media and so forth, there had been a lot of topical issues put into the marketplace. And I say that because it is a very typical political strategy to put in this sort of thing and test the waters. Now, that may not be for now, but may be in respect to the future. So I just do raise, given the current economic environment, is this somewhat the calm before the storm? So again, I'm more inclined to see changes likely to happen in our 2023-2024 budget that we will see in May next year. But the fortunate thing at this point in time is there's very little action that we need to focus on from this budget from a superannuation perspective. So let's go through and take a look at each of these announcements to help you understand what has happened and what they intend on making law. And some of these are actually well in train already. So the first thing, and this is an important announcement, because what we commonly see is things get kind of thrown into budget papers, then we go into consultation, and then nothing proceeds because of that, but we don't know whether the government has it on its radar or not. So this actually goes back to the 2018-19 federal budget. And what the government at that time was looking to do is reward trustees of self-managed super funds that had a clean bill of health. And that clean bill of health was going to mean that the audit cycle didn't have to happen annually, but rather was going to happen on a 3-year approach. Now, again, there was criteria that needed to be met around that, around compliance issues and so forth. But ultimately what transpired is the idea was whacked pretty hard from within the industry, from in particular the audit profession. But by and large, the concept of an annual audit sits front and center as an integrity measure around the fact that mum and dad generally control their own purse strings when it comes to retirement savings. So the integrity measure naturally won the day. And the government didn't want to, or didn't appear to commit to looking at this at any point in the future. However, they never formally said that that was the case until now. So now what we have seen is the government permanently take this issue off the radar, and therefore we do move forward with that clear certainty. And you'll see as I go along in these slides, I've just added some comments on the side here, just around some of my views as well. So again, this was strongly denounced by the sector at that point in time. There was issues around with audits. I clearly remember this. There were issues around planning. How do you plan? How do you potentially create a clean, does the clean record happen automatically? What level of change is the auditor going to make that may move clients in and out of that process? So there was a whole range of things that ultimately came about. But the really positive step here, and we hope that we see this with this government, is that they come out and they actually reiterate whether these things are on or off the table. If they're off the table, tell us. It gives you, it gives me, it gives the industry certainty to allow us to plan based upon whether these measures are going to occur or not. And this then also leads into our next topic, and this is around the deferral on the residency rules. So again, back in 2021, 2022 in the federal budget, there were a raft of superannuation changes, and that included changes that we have seen take effect from the 1st of July 2022 and also in 2021. So we're talking about the exempt current pension income changes that many of you are working through in the 2022 SMSF annual return. We also saw things like the removal of the work test to be able to make voluntary contributions up to age 75. Now, in that federal budget, though, there were two key SMSF measures. And one of those was around the relaxation of the residency rules. And it was to be adjusted in two parts. So the first part you can see there is to increase the safe harbor. So central management and control currently has a 2-year safe harbor period in play around the central management control ordinarily residing in Australia. So the approach here was to expand that temporary absence period with the central management control from 2 years to 5 years. The other area was to simply remove the third limb to the residency rules requirement, and that is the active member test. Now, again, this was an announcement we saw in terms of the other superannuation changes, so what I call the non-SMSF superannuation changes. Those changes went through fairly quickly. They were fairly easy in their application, so we didn't need to have any key level of consultation. So the removal of the work test, it got pulled out of the SIS regs from 704 into the Income Tax Assessment Act. We saw changes to the downsizer contribution age from 65 to 60. Again, they're simple amendments that would occur. This measure, however, needed to go through some form of consultation, then naturally into bill format, and then to be approved. The problem is at this point in time, we have seen nothing from the government or Treasury as an exposure draft to allow us to consult and provide feedback around the operation of these requirements. The problem is the intention of these laws were, of course, meant to start from the 1st of July 2022. So what we have now seen here is the fact that the government has put a start date on here, being the commencement of these measures to the income year commencing after the date of royal assent. So if this was to be resolved, say in May of next year, then it would apply naturally from the 1st of July 2023. If it was October next year, then we're moving to July 2024. So again, this is a positive outcome to some extent, because it does give us certainty that the government is committed to this measure. Okay, so we will therefore be likely to expect some further information come out from Treasury in respect to the amendments that I've spoken about here that were announced in that prior budget. So yes, we would have liked to have seen this earlier, because there is a distinct disadvantage that self-managed super funds have when we compare to APRA-regulated funds and the ability to contribute whilst they may be away overseas due to the operation of that active member test. But if I take the half glass full, the half glass full here is that this remains on the government's radar, and therefore we should feel positive that there will be a commitment to looking to make these changes as was previously announced. Now, the other area here is around a penalty unit increase. So we're going to see this shift from what is currently a $222 penalty unit up to $275 from the 1st of January 2023. Now, this quite clearly is much more broader than the SMSF sector. It'll go towards failure to lodge penalties and a whole range of things. Now, interestingly here, the amount will continue to be indexed every 3 years in line with CPI as per the existing schedule that is in play. So we're seeing an increase from the 1st of January next year, but we're then going to see a further increase, noting that the next indexation then applies from the 1st of July 2023. So we've got a January 2023, 6 months later, July 2023. So the impact here, again, not only failure to lodge, but across our administrative penalties, we're seeing an increase to these and therefore a direct impact on the SMSF sector. So one example you can see on the right-hand side here for a breach in respect to the lending to members. So we're looking specifically at Section 65 of the SIS Act that has a 60 penalty unit applied to it. So what is currently $13,200 that the individual would need to pay themselves, where they were, say, individual trustees, or if it was a corporate trustee where the directors would be joint and severally liable, that penalty will increase now from $13,200 up to $16,500. So again, a fairly sizable jump there. And that failure to lodge framework, again, can come into play with our transfer balance account reporting, where the government, or where the regulator, I should say, will be looking to maybe introduce or start to levy those once SMSFs move to the quarterly reporting framework from July 2023. There will be a shift at some point in time where they move from education to enforcement around this. And again, it may be that time frame where all SMSFs move to that quarterly time frame reporting, and therefore those failure to lodge penalties on time then also kick in here with this penalty unit change. All right, let's keep moving on. The other area, and this actually isn't really an announcement when you've already got this bill well in progress. And so you can see what I've said there on the right-hand side. You wonder whether it's kind of just content building, I guess, in many respects. But this was an election commitment by the government, actually on both sides of government. So what we do know from this is that we have previously seen our downsizer contribution age limit at 65 years of age. We then saw that reduction from the 2021-2022 budget from 65 to 60. This now is intending on removing or moving that needle down further from 60 to 55 years of age. And the reason why I make that comment on the right-hand side and say, well, is this really an announcement, is because of the fact that we have Treasury Laws Amendment 2022 Measures Number 2 bill was introduced into Parliament in August 2022 and currently sits within the Senate. So we've got a second reading that has already been moved. And the intent here is that once this is passed, it is intended to take effect from the first day of the first quarter after it receives royal assent. So right now, if this bill is finalised before the end of this calendar year, this rule change will take effect from the 1st of January 2023. If this is not resolved until February, then we are looking at 1 April 2023, and you can work that out obviously from there. So at this point in time, from the planning perspective, you are dealing with downsizer contributions based upon age 60, but you may have sales coming through at this point in time, and then settlement, and then 90 days thereafter. Your client may be 54 years of age now, maybe turning 55 in December or January, for example. If this law does come through, you might have clients that then qualify and move into these downsizer contribution requirements. But I think what you also need to contemplate in this, and we have spoken about it at our SMSF days earlier this year. If you didn't go, we've also got it still available as our online course as well. But we talk about some of the, I guess, risks, opportunities, considerations around when you might actually make a downsizer. So whilst the age of the downsizer is reducing, and the intention of this is to try and get people that have larger size houses that no longer suit families because many of those kids have left home, the intent of these laws by reducing that age aren't necessarily going to be used at that point in time. In particular, if that client may then look to rebuy and downsize, not necessarily downgrade, and then they may want to have another bite at the cherry at a future point in time. So again, just a few things there to contemplate, and we did cover that in quite a bit of detail, like I said, at our SMSF Day this year. So again, just be aware of that and be very conscious of that moving date. And we will keep all of our members up to date through our changing face of SMSF that we run each and every quarter as these bills continue to progress. The other area up here is around incentivizing pensioners to downsize. So this is kind of the other side to the ledger here, with the ability to not only contribute additional proceeds above and beyond contribution caps as a result of the sale of a principal residence where it would naturally qualify, but pensioners that are looking to downsize the family home will see the sale proceeds exempt from the asset test, currently 12 months extended for 24 months. So a couple of things to note here. So it's important that this exemption here only applies to the principal sale home proceeds or principal home sale proceeds, so principal residence, which a person intends to use to purchase a new principal home. So we're tagging, in essence, the fact that the money that has been received from the sale of the home, we're saying that amount of money is being tagged to then have exempt because that is being used to purchase a new home. So it is not being used to contribute that money into superannuation. Now, furthermore, for income test purposes, only the lower deeming rate, so currently at 0.25 of 1%, will apply to those asset test exempt proceeds from that principal home for that period. So again, we're not going to have the threshold, the higher threshold once we reach that, apply during that point in time. So from my perspective, there are some important planning considerations here for individuals about the interplay between making the downsizer contribution. We've got our 90 days after settlement to tag that as such, versus tagging it and keeping it outside as for use for principal, as a principal home use, and therefore getting the asset test exemption. So I can see up to age 75 here, there might be the ability to keep some of that outside of super, tag it, get it exempt, and you'll be able to still get it back in as a non-concessional, whereby after 75, where there's no ability to contribute other than as a downsizer contribution, you might need to contemplate those two things together and think about how you might be taking advantage of getting the money into super, but losing some of that asset test exemption timeframe that exists with this incentivizing measure that the government has announced. So let's keep moving on. Like I said, there wasn't a huge amount, but I did want to kind of fill your bucket with everything that has been happening. So the other one here is around Commonwealth Seniors Health Card. Now, again, this was something that has been in the pot for some period of time. It was an announcement in and throughout the election campaign that both sides of government had committed to. So this measure has been announced previously. So again, it was put in the budget papers, but in essence, we are all the way along now, because looking at this morning, social services and other legislative amendment lifting the income limit for Commonwealth Seniors Health Card bill has now passed both houses yesterday and is awaiting for royal assent. What this is going to do is it's going to now increase the income thresholds for both singles and couples. So currently, or previously, I should say, that threshold for a single was $61,284, now increasing up to $90,000. And for a couple, $98,054, up to $144,000 or $72,000 per single as a couple. Now, the intent of these laws was to take effect in respect to the changes with income stream payments from Centrelink from the 20th of September 2022. So what does this mean for you and your clients? For a range of your self-funded retirees, it is now important to be going back to them and looking at whether they actually fall within the qualifying income level to obtain that Commonwealth Seniors Health Card. Where we look at the definition, whilst we might have an account-based pension that is tax-free for income tax purposes, after the 1st of January 2015, that amount of pension is calculated for the purposes of the Commonwealth Seniors Health Card. So again, just a reminder here, yes, there's a threshold increase. Those pension amounts may count, but those clients that have pre-1 January 2015 income streams, those amounts don't even count towards the entitlement to that Commonwealth Seniors Health Card. So be very careful around those pensions in terms of ensuring that the minimums are taken and that you don't potentially unwind them and repurchase them that may prejudice the ability to not only access age pension, but also with the Commonwealth Seniors Health Card. So again, going back into your client base and identifying those with what is a fairly substantial change. If you think as a couple, we're looking at $45,000, $46,000 nearly as an increase that is going to bring in a large number of your clients and the benefits that they get naturally with the Commonwealth Seniors Health Card. Okay, so let's now move on and go and discuss what wasn't announced. And there are a number of things here, like I said, that were discussed throughout the media around, would we see this, would we see that? And ultimately, what I just showed you is what we did actually see transpire in the budget papers. So I want to work through with you here a number of things that the government has now probably more than I would argue as either A, put on the back burner, or B, just simply don't have the time to do it, but will commit to doing it. So the first one here, if we look at our top left, there was some discussion about whether we would see a freeze to indexation. Okay, the way that inflation is currently tracking, CPI is the measure for us to increase the general transfer balance cap. That is already intended to go beyond $1.8 million. If you do the calculation around CPI, we are already there. Given that inflation is still at very high figures, it is potentially that we go from 1.7 to $1.9 million. Now, there was discussion whether that would have occurred. Labor may put some sort of temporary hold on the CPI adjustment. That would have impacted not only the level of retirement phase benefits that could be started, but it would also impact the way in which contributions could be made as well, because our non-concessionals are obviously linked to the general transfer balance cap. So nothing at this stage. However, again, we have a May budget next year prior to 1 July 2023 that could put a stop to that. If we move across to the top right here, the other thing is we are still waiting clarification from government around the amendments to the non-arm's length income provisions, and in particular, the non-arm's length expenditure requirements that fall within Section 295/550. So the previous government, after industry had worked together to consult and try and find a solution to the ATO's view in respect to the operation of these gnarly provisions, the former Senator Jane Hume did say on behalf of the government that they acknowledged the problems and would look to do a rewrite to address these issues. At this stage, again, we have nothing that give us any further guidance as to what the current government is going to do, which means that we have a clock that is ticking through to the 30th of June 2023, where the ATO has their compliance relief in respect to non-arm's length expenditure that is incurred of a general nature that connects itself to all of the funds, statutory and ordinary income. Okay, so that relief, then we have seen over time the ATO extend that, but we would like to see some closure on this particular topic. It would have been helpful if we had have got something from the government in respect to this inside the budget. We didn't, so we continue to wait, and I'm sure, as has continued to be the case, there'll be plenty of discussion and debate around what a resolution may look like. Now, let's move to our bottom left here. And whilst I was full of praise before about the clarification and what seemed to be a commitment to the residency changes and how they will impact SMSFs, what was disappointing is we didn't see a similar outcome in respect to SMSF legacy pension conversions, because this, of course, was the other part to those two SMSF measures. Now, again, Labor formally acknowledged this delay to the residency rules, but there is no commitment here to the 2-year amnesty that the government was going to provide us to unwind these income streams that go back to 2007 with our market-linked pensions, and then also prior to 2005 with our defined benefit income streams, life expectancy, fixed-term complying income streams, and the like. So again, something that we would be hopeful to have seen. We didn't see anything further on that. And that one is disappointing, like I said, insofar that we kind of got one message on one side, even if the fact that it was just deferred, it sort of showed a commitment by the government that they were going to look at it and give us some resolution. We get nothing on the legacy pension side, and therefore we need to continue to wait and see. And the other one that did get a lot of airtime, but we didn't see anything, and I say anything probably at this point in time, is this super cap for high balances. Now, this all flows off the findings in the retirement income review and the notion within that report around adequacy and the imbalance in super tax concessions that high individual balances within superannuation obtain. So yes, SMSFs do have a cohort of large balances, but it is a more industry-wide issue in terms of, there are APRA funds that do have members clearly with high balances. But this sharp focus, in particular within the current economic environment, was saying, do we need to cap the concessions that should be available within the retirement income system? And the concepts, I guess, that are being talked about is some type of balance cap. Say it's at 5 mil, it might have been at 10 mil. There've been discussions at 3 mil. I guess you can kind of pick a number out and discuss the merits of each of those. But at this stage, again, the government hasn't pulled the trigger on this, but I would be very surprised if they don't react to this area by the May 2023 budget. So it seems to be a fairly, I wouldn't say simple resolution, but if you kind of do apply the pub test to it to say, well, the benefits that these funds are getting, yes, there's a $1.6 million cap, but the concessional treatment is far outweighing the benefits of what, say, a full age pensioner would be getting, some type of cap or limitation, whether it's applying by removing assets out of superannuation or whether it's just imposing a higher rate of tax. These are all things that would naturally come and be debated throughout, I guess, the next 4, 5, 6 months in the lead up to the budget and submissions that would naturally happen thereafter. Now, interestingly, when the federal coalition government, former government, introduced the transfer balance cap, Labor, when they were looking to seek government at that point in time, did actually publicly state an earnings threshold based upon member balances rather than this RBL style cap that we do have today. So Treasury do have a mechanism, I guess, in respect to how they might look to tax balances above a certain threshold or levels of income that go across a threshold where there is an implied earning rate that may have occurred at that point in time. So it's not as if they would be starting from scratch here. So we, again, just need to wait and see. If you want to kind of find out a little bit more about this, go and have a look at the retirement income review to understand, I guess, where the government sits and the recommendations that have been made around adequacy and the superannuation tax concessions. And the final thing I just wanted to note on this is also, I think there's going to be a bit of connection or linkage between the debate as to whether stage 3 tax cuts will occur or not, will the government continue on and deliver those tax cuts or won't they? Now, if they do, I would suspect we'll see some type of connection to our Div 293 thresholds. So whilst they might be giving something up on one side, expect them to potentially be taking a little bit back more on the other side. So we did see Labor again in the past look to reduce the Div 293 threshold from 200. It was 300, if you remember, went back to 250. Labor was proposing to reduce that down to $200,000. So again, these are all the things that you can kind of foresee. If they're looking at giving something somewhere, then there may need to be a question of taking it back somewhere else. These are all areas that we have legislative frameworks that exist, and therefore mechanisms just to simply change thresholds become a fairly easy approach for them to do. So the other thing I just wanted to touch on as we get close to wrapping up today is just a couple of things, that we will see as an industry continue to get pushed forward, especially as we lead into the federal budget next year. Submissions will happen in the earlier part of the year, of course, and then in the lead up to that federal budget in May 2023. So quite clearly, things like simplicity of the system, in particular around transfer balance cap, becomes important. We now have personal caps in addition to our general caps that do create a fair amount of complexity within the system, and therefore any simplification of that can only be seen as a good thing. We have multiple TSB thresholds. So we are seeing one removed in the SMSF sector around the $1 million TSB threshold for the purposes of quarterly versus annual reporting. But the other thing, not only would we like to see a reduction in this, but we would like to see those that do remain, they are actually consistently applied to indexation, as opposed to having some that are indexed and some that are not. So I want to give you a couple of examples here to demonstrate the differences. So we have our general transfer balance cap linked to CPI and therefore moves in those $100,000 increments. But our retirement exemption, whilst the small business CGT limit increases, and it's now sort of 1.6 mids, the retirement exemption stays at $500,000. So naturally, we would like to see some of those move in consistent terms with the actual threshold, that CGT cap threshold. The same can be said in respect to disregarded small fund assets. So again, general transfer balance cap has moved from 1.6 to 1.7 and then likely 8 or 9, but our disregarded small fund assets is a hardwired figure at $1.6 million. And the same principle applies with our unused catch-up concessional contributions at $500,000 as well. And the last thing, I guess quite technical, but there are now what are called DDO and TMD, design and distribution and target market determinations, that form part of financial product disclosure requirements. There is some confusion in respect to its application to SMSFs. Generally, we don't want to see this type of requirement really being required in the SMSF landscape. So again, getting some resolution as to we're in or we're out would be critically important there as well. So that is pretty much it from me. Like I said, it was a fairly quiet budget in respect to superannuation. My gut feel, if I'm a betting man, I would say the level of sleep I got on Tuesday night compared to what it will be on the Tuesday in May 2023 is going to look very different. But as is always the way at Smarter SMSF, this is about keeping you up to date and letting you know about what is happening within the SMSF sector. So if you do have any questions and so forth, you can please feel free to ask those now. We'd be more than happy to take those on board, but otherwise have a great rest of the day. You can find out more about the events that we have coming up on our Smarter SMSF page, including, I know we have a Failing the Pension Standards webinar in November and our Changing Face of SMSF to wrap up the year. And shortly, we'll be getting our calendar out ready for the first half of 2023. I can't believe I'm saying that, but that is the case as well. So thank you once again for joining me. Have a great rest of the week. Take care and bye for now.